So let's talk about options trading, their Greeks, and how we can take advantage of them while trading. I'm going to outline specific Greeks in this video, such as delta, theta, gamma, and implied volatility, while also outlining how to use them in real-time trading example in the most basic manner as possible. I know a lot of guys online, especially in these YouTube videos, like to overcomplicate it, so they sound like Einstein, or they're doing some crazy math. Guys, it's really not complicated. We're going to keep this short, we're going to keep this simple and to the point. Before we continue, I want everyone to follow my Twitter to stay up to date with any trade theories, analysis, or general commentary that I post nearly every day with updates around trading related activities. In general, Twitter is a great place for me to have a quick discussion or provide insight into future trading discussions. With that being said, let's go right into the Greeks. Okay, so delta. What is delta? Delta is simply the rate of change in the options premium. The premium being the price that you pay for within the contract. So in my case, for example, I like to trade the S&P 500 index or SPY ETF. We'll look at SPX for here with a live option chain. We can see that SPX closed at 40.70, and these contracts that are tomorrow, because this is Sunday, so December 5th on Monday, we'll see that, for example, 40.80 calls are going for $7.70. Now that's $7.70 times 100, because one option contract for anything, right? QQQ, SPY, SPX, Amazon, Microsoft, whatever. You take the options premium and you just multiply by 100. So you're not paying $7.70. You're actually paying $770 for this 4080 call. And this is really, it sounds basic, but trust me, it's important because a lot of beginner traders, they just, they quickly enter their option trading. They're all really excited to trade. And then all of a sudden the market goes against them. They quickly lose 50%. And they're like, wait, why did I lose $400? I thought I would lose like $40. No, or $4, right? No, it's actually because the contract is not $7.70, it's $770. So keep that in mind. Now, delta, which is the rate of change of the premium, think of delta like you're driving a car and your speed is effectively delta. Are you going 30 miles per hour or are you going 70 miles per hour? The faster you go, the more your gap is going to be closed for your destination. The quicker your gap is going to be closed for your destination. And it's the same with delta. If you choose a 4080 call and the price of SPX is at 4070, well, until you get into the money, meaning that you cross 4080, the SPX would have to cross 4080, right? Go to 4081 or 4090, whatever. That delta is only giving you 0.335 premium or 0.3337 premium per dollar movement up and down. So effectively, the farther in the money you're taking a contract, let's say SPX is trading at 4070 and you take a contract that's already in the money, a 4030 call, that is going to have a delta of 0.844. And it's way more expensive. As you can see here, it's $40 or $4,000 versus this 4080 call, which is only $800. Why? Because delta is baked into the premium. It's the market's already expecting this contract by the time it expires tomorrow by the bell to be worth value, right? Because if it's in the money, it's worth intrinsic value, and if it's out the money, it becomes zero. So the market's saying, well, this is already worth something, and it's almost the same as trading the shares itself. If you go deep enough in the money, there's no difference from just buying the SPX and trading it raw. So really, for me and my risk tolerance, because when you buy out the money delta, what you're doing is you're buying risk. So the farther out the money you go, the more risk you take because it's more extrinsic value. It's more speculative, but you can make more money, right? For the same price of 140.30 in the money call, I can buy 4 or 5 of these 4080s. And if we cross this threshold and get in the money, well, guess what? They're going to go from 0.3 delta to something like, 0.6. And look at the contract's price then, about $20. So you just doubled your money times 4 contracts. So not only did you get more contracts, but that option net you 100% return of investment. But at the same rate, let's say the market goes the other direction. It doesn't go to that 4080 threshold, and it just, it either chops sideways or it goes lower. Worst case, it goes lower and you have a tight expiration. That contract loses a lot of value quickly. You can go to a 50% loss or even 100% loss within a mere few points dropping. So that is effectively delta. Now the next Greek I want to talk about, which impacts delta, is called gamma. And gamma is how we said delta is like speed. Gamma is the acceleration of that speed. So if you go to a drag race with the Honda Civic and you're racing a BMW, you're not going to beat that car on a 0 to 60 unless you have some kind of booster, right? Nitrous booster, something special with your Honda Civic. That is what gamma is. It's that nitrous boost that can send a delta on a rocket ship. And it can make the delta go from, 0.16 to 0.8 in an instant. And gamma in particular is more effective at the money. So let's say your contract here, I want to show you guys the option chain here. And this was a trading day, December 12th. There's something very interesting you can see with the premium here. And these are the 40-80 calls. So this is December 2nd, and we're looking at the price being right over here, okay? Right over here. Now, when the price came all the way up to 40.80 and crossed in the money, look what happened to these premiums. They went from lows of about $6 or $550 or $460 at 1300, right, which is 1 p.m., all the way within 1 hour, 60 minutes, they went to $15, $16. And that is effectively a gamma squeeze, because the end of the day, all the contracts derived of is delta and gamma. And this is going to get me to the next Greek, which is theta. Theta is time decay in options, which is the number one enemy for an options contract buyer. Option contract sellers, the guys that sell you the contract on the other end of the trade, they love theta because theta is their insurance. They have, they're getting more money from you. You're paying a premium for that time privilege. So what I mean by that is, let's say you think the S&P 500 is going to be worth, we'll mark this here, 4,100 sometime soon, but you're not sure if it's today, right? Market's choppy, you think it might dip a little bit, consolidate, and then head higher. Let's just say that's what you're thinking, and you think that it's not going to happen maybe within a week, but it might happen within 3 or 4 weeks. So you go to your option chain, and you look at something at the end of the month, right? And you look at 4,100. Well, look at the price of that premium. It's asking for $68, which, remember what we said before, times 100, it's $6,800 a contract. So why is this 4,100 so much more expensive than the one that's expiring the next day, which is only $3.40 or $340? It's because you're paying an excess for premium for that time. You're paying the guy selling the contract the insurance of time, because time is only going to benefit you in a lot of these setups, right? You can suffer like not having the perfect entry timing and everything like that. If you're not really good at timing, or you're not super precise, which with these really short-term expirations you have to be, then a longer expirations will be more beneficial to you. That being said, the caveat with this is that the longer the expiration is and the more you pay for the theta, the more impact it's going to have in your premium. So let's say, next week, the market's just trading flat. So let's just say it's going flat at 40.70 and you have a 4,100 call and nothing's really happening. You're only going to lose money on theta, but not by a lot. It's only going to be a few cents here and there. You're not going to notice it too much. Just like you age, you're 20 years old, you're going 25, 30. You're not really noticing it. But once that expiration gets to week 3 or even week 4, every single day thereafter, you're going to see new problems arise, right? You hit 50 years old, new problems arise every single year after that. Same thing with time decay. Every single day after week 3 on that 30-day expiration of that contract, you're going to lose a lot more value in theta. And if the market continues to go flat, you're going to lose so much money really quickly. So it's important to understand that there's risk with theta as well. And lastly, and one of my favorite Greeks, is implied volatility. And what implied volatility is the demand for the options contracts in the current day, the next week, month, year, whatever. Implied volatility is one of the most important metrics for an options trader, especially in this highly volatile bear market, because what it tells you and what it foreshadows is possible upcoming large movements in the market. And what I'm going to go into in this trading example is exactly how I used implied volatility to predict the 100-point move that occurred on November 30th when Jerome Powell was talking about inflation and rate hikes, and how I capitalize off that with a long strangle. But essentially what implied volatility is you're paying for the option, the expectation of the market. So let's say implied volatility right now, we'll go to these December 5th contracts. They're trading at 20%, right? They're about 20%, 18%. Let's say the market, and we can go to the futures chart here so you can see what's happening in the futures. Right now it's about 20.57, okay? Let's say we go all the way to 1 a.m. or 6 a.m., right? The Europeans start trading, the Asians start trading, and this implied volatility number, it starts to increase, right? It goes from 18, it goes to 30, and then by 6 a.m. it's 50. And we have an economic data report coming out at 10 a.m. We can assume that there's going to be a large movement, and you're paying for that expectation. So let's say you pay, it goes to 50%, and these contracts at the money, 40.70, go from $11 to $30. And the market doesn't have a large move. What occurs is a phenomenon called IV crush, because what's unknown now becomes known. It's factored. And that IV that was 50% before the data event, right? Like Jerome Powell talking, an economic report coming out like the CPI or something like that, jobs report, it now crushes down to what it was before, 20%. And just like time decay, it's baked into the premium. You lose it. It's gone. So that does hurt you as a contract buyer, as an option buyer. It actually benefits people that sell the premium and take that risk, because they're taking the risk that, well, if I'm selling a contract and there's a large move, they're betting that there's not going to be a large move, right? Now, in my experience, though, in this market environment, the IV is extremely accurate. I would say about 90% of the time, it actually foreshadows to the T exactly what the market's going to do. And what a little tip is that whatever is trading at the money, so 40.70 right now, we would look at the strike. This is roughly the expected move. If you add the ask for the call and the put at 40.70, we have $17.70 and $11, roughly going to about $28, $29, right? $30. The market is telling you that at this moment, at about 9 p.m., the market is expecting a 30-point move maximum high or low, maximum. Right? But what if that IV now increases, like I said, to 50% later on? Well, then it might be a 60-point move. So it's very important you understand implied volatility and how it affects the premium. And if you purchase the contract as a buyer when the implied volatility is cheap and it increases, that helps you out. So generally speaking, you do want to look at purchasing long options, meaning you're buying the contracts of options when the implied volatility is lower, and you want to be more careful when it's extremely elevated. Now, with that being said, let's hop right into this real trade example where on November 30th, I used the option Greeks and especially implied volatility to place my long strangle trade and capitalize off a 130-point move for a 600% ROI on the call leg. And I'm going to detail exactly how I did this, what I saw in the market that led me to place this trade, and how I managed my risk real time. Okay, so let's get into this example. Now, I've already marked out the difference in implied volatility as the day went out here before Jerome Powell talked on November 30th. Now, as I previously mentioned, implied volatility, what I was watching going into this trading session is how IV was being manipulated over the hours. So before I got off my trading session at night, I like to mark the various changes and discrepancies in the implied volatility contracts. I marked here in the futures trading session at 10 p.m. Eastern that the IV for the contracts I was looking at the money were 30%. And then I went to bed, I woke up really early, and I noticed something interesting, which was implied volatility was at 50%. Now, I already had an expectation going into this trading day that there was probably going to be a large move. Every time Jerome Powell has talked in this market, we break out of the range. And what do I mean by breaking out of the range? Well, if we let's go to the hourly chart here, we can see that I've marked my support and resistance supply and demand levels. As I've talked many times before, Historical statistical levels is how you effectively trade the market. When the market is ranging and is bouncing between demand and supply, you want to look to take calls low or puts high, or just simply sit out and not trade at all. A lot of people would get chopped up in this middle area when they trade options, because what did we say before? If the market goes sideways and you're day trading options, especially with short expirations, they lose value very quickly. You have to have movement for those premiums to make money. And if they don't, you go into the loss very quickly. As we can see here, I marked a supply imbalance at 40.24 and 40.30, and a demand imbalance here with a retest short below. And this is very important here, because what ended up happening in this trading session is, before Jerome Powell talked, IV was at 80%, okay, which was extremely elevated. It was even more than I expected. 80%, for context, is effectively what we've had around CPI. If you go look at the charts, every single CPI event we've had anywhere from a 60-point candle on the data release to 100-point plus candle. It's extremely volatile, with sheer amounts of volume and emotions coming in the market. And as traders, we love to capitalize off volume, price, and obviously other people's emotions, investors' emotions, whether they're euphoric or fearful and panicking, the market selling off. It doesn't really matter. You just want to make sure the trend is on your side, you're identifying it correctly, and you're taking the right trade with the right risk management. And what I saw here, especially at, what time was this? About 12 p.m., something very interesting happened here on these bottom of candles. 2,000 iceberg orders on the order flow, which I use as bookmap, were filled here. And what iceberg orders are hidden orders in the market. And effectively what big players do, whether it's market makers, institutions, or just some trader with a big pocket, or multiple traders, who knows, right? They're front running oftentimes because they have insider knowledge, right? We know the markets are highly manipulated, and somebody out there, groups of people, always know what's about to happen, or they orchestrate movements, because obviously the market's been extremely overall bearish, right? We had a lot of rejections. A lot of shorts are piling up here, and when shorts pile up, you can squeeze them and make money off of them, because when you squeeze a short out, they by force become buyers once their stop losses get triggered. And so seeing this, I entered my strangle here, puts and calls, and I was anticipating at least a 70-point move when IV was at 80%. And so my plan with the long strangle was, I didn't know if the market was about to go up or down. I had an inkling, I had a red flag because of these icebergs that got filled here, that we were about to go up, especially when all of this volume was green, right? And it was bullish and all the candles were green. I started scratching my head, and I was like, wait a minute, this is very unusual. And we had a lot of liquidity here, which on bookmap would be like a red beam of death. And usually that's used to entice traders to start buying puts or shorting, to think that demand is actually here, but oftentimes they're using that as spoof. But you know what's interesting and what cannot be spoofed, right? We talked about before in the introduction, equities and futures, their order flow can be spoofed, and you can get fooled. The option chain cannot. As we said, the option volume and open interest is black and white. Whenever someone writes a contract, it's written, period. If somebody buys it or sells it, it's done, period. There is no spoofing of that. And so what I noticed was the call sides, their premium was more expensive than the puts of equal call and put strike. So in this example, let's say we're buying here. If you were to buy a 39.40 call and a 39.40 put, what I noticed on the option chain was that, one, the implied volatility for the calls was more elevated than the puts, and the price, the asking price for the calls, was marginally more expensive than the puts. And on top of that, I was seeing a volume spike on the option chart, on the option chain for calls. So all this information together led me to believe we were going to go up and rally really hard, and ultimately we did. And so once we had this initial move, if you're someone who didn't strangle into this, or you didn't get a call or put and you're just waiting, do not FOMO up here, right? What have I said before? You want to trade level to level. That's all you can do in this market. It's trade level to level, supply and demand. And what you could have done here is, instead of chasing here and getting a market fill here for the market to go back down and stop you out because your stop loss is here, what you can do is you could have looked previously at the pre-market swing highs, right? We had 2 rejections here. And what do? Well, you just quickly mark that. And once you see that line here, this black line, you would look to enter your calls off here, because you know people, beginners, amateurs, whatever, are going to place their stop losses there, and their stop losses become your buy orders. So now you enter your calls here, you can place your stop loss somewhere more effective, maybe below VWAP. You can now risk more room for margin of error before the possible move higher. And ultimately we go higher where we break this area where again, this is a seller imbalance area, right? I marked here on the 1 hour chart, supply imbalance 40.24 to 40.30. However, I'm not going to front one puts because I know on this large movement, there's going to be a lot of momentum. And I said, if we break this level, the supply imbalance, I'm going to long above if bullish momentum. And all you want to do when you trade is, if this happens, then this happens. If, then, and what statements. Just like your programming, if you're into programming at all, it's all if, then, what statements. That is how you should think when you're trading. If we break supply imbalance 40.24, then we hold for a retest and I will take a call, right? That's how you need to think when you trade. And so we came for a retest, and I didn't buy more calls here. However, I held the strangle. I held my call side. Instead of panicking and closing it out early here, I held it for the run up higher, which led me, go from a 300% over here to 600, right? A massive difference in only about a 20, what was this roughly? A 30 point move, 35, 300% ROI difference, right? Massive, just for holding it for another 30 minutes. And as we mentioned before, the reason why I held my 39.90 call on top of that is because gamma was helping my delta increase in value exponentially, especially as we were heading into the bell and we continued into my direction. We know that theta was down and delta was going up because of gamma as well, right? And all this just led the contracts to go higher and higher and higher in value. In fact, what's even funny is I saw someone online it was like Wall Street Bets, Reddit. They took a lottery ticket call right over here for about $500, okay? They took a call, I think it was at 40.75, and they took a call for 40.90. And this move, it led them from a $500 call into a $50,000 return at the bell because of how gamma and delta work at the end of the day when there's no more theta. Gamma explosion, it just explodes the value of the contracts up if they expire in the money. And that is effectively how I utilize the implied volatility and various other option Greeks in my trading decision for this November 30th day, where I didn't even have to be correct about the direction. I just knew there was going to be a large move thanks to the implied volatility and the rate of change that happened over these previous hours. And I capitalized off a large, quick, violent movement in the market for a 600% return on the call side. With that being said, I hope you guys learned something in this video. I hope you guys learned how to at least read these option Greeks in a very basic manner. I try to explain it as easily as I could. I know a lot of people like to overcomplicate it. It's not complicated. You need to tread the waters a little bit and learn the basics before you go really in depth with the advanced stuff. And I hope you guys enjoyed. Like, share, and subscribe. I'll see you in the next one.